Hi, I'm Christian.
Hi, I'm Marcella.
And I'm Melissa. And today we're going to be talking about financial crisis. And specifically, we're going to be discussing the Great Depression and then the recession of 2007 to 2008.
So, what is a financial crisis? A financial crisis usually consists of one, a sharp decline in the market value of assets, two, mass defaults on debt, including consumers and businesses, and three, financial institutions observe liquidity shortages. The Great Depression was an extreme form of a recession, often lasting many years. And a recession is a decline in economic activity lasting more than a few months.
So first, we're going to be discussing the Great Depression. So exogenous shocks. So all three of these were leading causes for the Great Depression. They were exogenous, meaning they happened outside the model. More specifically, they all ultimately had an impact on aggregate demand. All three of these caused a decrease in aggregate demand. First, the stock market crash of 1929. Two, cyclical downturn in investment. Three, a wave of bank failures. So what didn't go well? There are definitely several mistakes when policymakers were trying to fix the depression. First, fiscal policy. The government first raised taxes and decreased government spending. This was detrimental because it decreased consumption and thus aggregate demand. Second, monetary policy. The Federal Reserve wrongfully lowered money supply, raising interest rates. So investment decreased, thus aggregate demand decreased. And that is what turned that from a recession into the Great Depression. And a fun fact, did you know that the ISLM curve did not exist in 1929? So the policymakers couldn't look and analyze the short run. So how could they learn from these mistakes? So at first, the economy was wrongfully contracted when it should not have been. The Fed messed up regulating the banks and the money supply. So President Roosevelt came in and signed the New Deal, which were financial reforms and public work projects, which eventually helped the economy improve. So also, fun fact, thankfully, Keynes came around and offered the ISLM curves for help.
Now we're going to talk about the Great Recession from 2007 to 2008. Some of the exogenous shocks were cyclical decrease in investment, the US housing market, two, bank failure seized up in credit, and three, the stock market crash.
Okay, so a big cause of the Great Recession of 2007 to 2008 was the mortgage securities market bubble. So what exactly happened with that? So the Great Recession is often called the subprime recession because banks took on too many risky or subprime loans that resulted in a complete collapse of the US housing market in 2007 and 2008. So I put out four main reasons why this happened. One, banks took on risky loans. Two, banks sold high-risk mortgage-backed securities to unaware creditors. Three, too many people bought homes they could not afford, creating a inflated price for housing. And then four, most of these people defaulted on their mortgage loans and the housing market crashed. I believe the housing market crashed about 30%. So how did our economy recover from the recession? Through monetary policy, the Federal Reserve was able to stop bank failures with temporary liquidity and ultimately increase the money supply. In this case, they responded very quickly. In terms of fiscal policy, we enacted the American Recovery and Reinvestment Act, which is a stimulus package. Most investments went into infrastructure. This filled recessionary gaps for those who lost their jobs. Thankfully, the government was large enough to fix the issues and bail out large corporations. They also used automatic stabilizers, which is awesome. Unlike the Great Depression, they avoided contracting the economy when it was already in a recession. So therefore, we avoided another repeating history and entering a depression. So what are the preventative implementations that the government put in place in order to ensure that we didn't create another housing market bubble and we didn't create another perfect storm for the recession? So there are two main things that really stood out. One, the TARP fund, which was a bailout fund, which from bankruptcy. It would hurt the economy if too much of these institutions failed. So we made sure to pour money into those companies. And to the Dodd-Frank Reform Act. So this act put in new requirements for banks in terms of capital and liquidity requirements. And banks now had to have a debt to equity ratio that does not exceed 15-1. Thanks for bearing with us. Have a good day.